Welcome, everybody. This is Edgardo, Balentine.
And this is Scott DiGregorio, and welcome to the Real Estate of Tomorrow podcast, where we're going to discuss the rapidly changing landscape of the real estate industry.
And the steps that you need to take today in order to survive tomorrow.
Look, I'm going to give you the perspective of a 25-year veteran, somebody who has been there and done that.
With Jesus line for all fart, okay?
Screw you, man.
Look, I'm going to give you a fresh perspective from somebody that's applying those steps today.
So that basically means you're young and you don't know shit.
All right. Let's get this started. All right, everybody, welcome to another episode. This is going to be an interesting one, my friend, because it's the beginning of 2022, and we're giving not only the predictions for the industry, but also our predictions.
You know, I always like this because this is the opportunity to just put it all on the table, man, because...
And be right.
Or wrong. Anybody who follows me on Facebook and social media knows that I love my posts where I talk about me being historically correct. But there is always a little concern when you're making predictions because we don't know. And let's be honest, there's more unknowns now than I would argue possibly ever before.
I'm going to tell you something. I'm just going to drop it right away. I know we shouldn't, but look, at the end of the day, this is what we think. Rates at the end of the year, they're going to be down to about 3%, maybe even less, and the market is just going to keep booming.
Oh, shit, man.
I know, but everybody's talking about a crash. Everybody's talking about, hey, rates are going to continue to go up. They're going to continue to go up. The truth is, based on the research we did, it's different.
It is different. And it's everybody forms a conclusion based on what the media is saying. And I don't know why people think that the talking heads on TV know what the heck they're talking about. If you want to see what's going to happen in the future, it's relatively simple. We just have to look in the past.
That's right. So look, let's get into it. And I think the best way to approach what's going to happen is breaking it down. At the end of the day, what we care about is what's going to happen with the market, right? There's a lot of talk about maybe this looks a lot like, 2006, 2007. The market is going to crash. The rates are going to go, crazy high. So I think we need to start with the rates, see what's going to happen with that, and then end up with what's going to happen with the housing market.
Right, because the interest rates have an unequivocal correlation to the housing market. Lockstep and key, there's no arguing that. So we have to start there.
Even in a market like the one we're in, right? Right now we're in Naples, 47% is cash transactions. But the thing is, even though 47% is cash transactions, they are competing with mortgages. So what's happening in the mortgage industry, what's happening with the mortgage transactions will affect the type of offers and the type of way that the investors are thinking about.
Yes, and in addition to that, as you know, interest rates impact the stock market indirectly, but regardless, they control them or impact them, and that has to do with the overall broader economy. And we might have a talk during this episode about the dreaded R word.
That's right, retirement,
recession. But anyway, so let's go ahead and dive in. Look, so just quick history lesson as to where we are today and how we got here. It's relatively simple. The coronavirus hit. The economy went crazy down. Everybody got scared.
Hit both of us, by the way.
Yeah. It did. It did. And the government, as they always do, started pouring money into mortgage-backed security bonds, lowering interest rates to spark the housing market, because the housing market has the largest impact onto the GDP than any other individual industry. And that led to historically low interest rates, a great refinance market, which doesn't really impact our realtor partners that are listening, but also a great housing market, because all of a sudden houses were a lot more affordable. And then people started moving all over the place, which we're going to talk about later in the episode. So that's how we got here today. But now we have inflation. And, we've talked about this. The Fed called inflation transitory, meaning it was short term. I was very public online that this is not transitory. Shockingly, the Federal Reserve has since changed their stance and said, you're correct, it's not transitory. But what does inflation have to do with everything? Edgardo, maybe you could quickly break that down for everybody.
Yeah, from a very, very simple perspective. Look, inflation matters because it really shows what your purchase power is with the current amount of money you're making. So it matters to us more than anything else because, well, a mortgage, it's a long-term debt, right? We're talking about 30 years, 15 years. One of the shortest is 30 and 15 years. So think about it from a very simplistic way. If you are an investor, and I'm telling you that if you give somebody $100, you're going to get a return of $10 a month. Well, if you're going to give this money for 30 years, for a period of 30 years or 15 years, you need to consider not just what purchase power you have with this $10 a month today, but also what you're going to be able to buy with this $10 a month in 5 years, in 10 years, in 15 years. So, for example, if right now you go to the grocery store and with $10 you can get, I don't know, 2 gallons of milk and bread and whatever, but in 5 years you're only going to be able to buy 1 gallon of milk, well, your way to combat this is to next time that you give a loan, that you give money, you increase this rate. So inflation is, like we like to say, the arch enemy of mortgage rates. As inflation goes up, what the investors are going to do is they're going to increase the mortgage rates.
Exactly, because people are going to invest in mortgage-backed security bonds with a rate of return. If you're going to earn a rate of return of 3% and the value of what you can buy, the cost of what you could buy is going up at 5%, why the hell would you tie up your money that long?
Well, and the way that the investor protects itself is the next time they do it, they just increase that rate.
They want more. And that's why inflation unequivocally, historically, with zero exception, always pulls up interest rates. And that's what's happened. Rates have gone up.
That's it. I mean, that's exactly what's driving the rate. Now, again, inflation, the arch enemy of rate, that's an easy way for us to follow this.
Sure.
Now, things got a little bit more complicated, Scott.
They did.
They do. Because, okay, well, that's inflation. Now, let's talk about what happened with the Fed and what the Fed can do. And let's just get something out of the way. The Fed controls the Fed rates, which oftentimes it's very, very confusing because when the Fed dropped the rates to 0% last year, well, everybody thought that the mortgage rates were 0%.
Give me one of those 0% refinances,
exactly.
Scott.
Well, tell me, how many of those did you write?
I didn't close any. However, I could talk about getting rates in the twos. Basically, is zero, but that's a different episode.
So why don't you tell me what is the Fed interest rate?
Okay, so the Federal Reserve controls the Fed funds rate, which is the overnight lending rate. When a bank needs to borrow money from the Federal Reserve, usually it's overnight. The rate of return they pay is the Fed funds rate. So directly has zero correlation to mortgage rates, but
not just that. We're talking about overnight. Again, the mortgage rates, we're talking about 10, 20, 15, 30 years.
Sure.
We're talking about the overnight rate. So yes, when it costs you $0 or 0% to borrow money that you need to repay the next day, it's not necessarily the same rate when you're borrowing for 30 years.
Right. But all of that being said, when the Federal Reserve raises or lowers the Fed funds rate, mortgage rates often, not always, but often mimic it. Why don't you break down why that is?
Well, what's weird about it is actually one of the ways that the Fed combats the increase in their rates, which, like we said, let's just go back and say, okay, the rates are going to go up with inflation. One of the ways that the Fed can combat inflation is by increasing their overnight rates.
Yes.
So even though it doesn't make any sense, and even though we on Facebook and Instagram and everything, we see everybody cheer when the Fed rates goes down and get sad when the Fed rates goes up. Well, most of the time what we see is that when the Fed rates goes up, the mortgage interest rates go down.
Absolutely. Absolutely. So, and by the way, it's slightly separate from this whole thing, but for all of the retired people in America that want to live off of CDs and things like this, the Federal Reserve raising rates is a good thing because that directly increases their rate of return.
And the Federal Reserve lowering rates, normally would lower rates of things like, short-term lending, like car loans, for example, and things like that. It's good for HELOCs. It's good for things like that.
Exactly. So the Fed has a couple of tools in their belt. Number one, they can raise or lower the federal funds rate. Number two, they can purchase mortgage-backed security bonds.
Whoa. Slow down a second. Okay. So, we're talking about the Fed raising and lowering rates. We're good there. What are you talking about? Purchasing and not purchasing mortgage-backed securities. Let's break it down first.
I'm going to assume all of our listeners follow us religiously and they know, but if there happens to be somebody new on the podcast, mortgage rates are controlled by the buying and selling of mortgage-backed security bonds. Okay, mortgages are packaged up in bonds and sold. People invest in them. And the more supply and demand, right? Third grade economics. The more people that buy mortgage-backed security bonds, the lower rates get. So what the government does to stimulate the economy and housing is they go, you know what? We're going to stimulate housing by lowering mortgage rates. And the only way they can directly control mortgage rates is by buying mortgage-backed security bonds. And we'll talk about some pretty staggering numbers here later.
Tell the numbers, man. I love to hear the billions of dollars.
Listen, man, let's do it. So although the number was much larger, the Fed is currently buying, and again, they've been dropping it, but they're currently buying $70 billion a month in mortgage-backed security bonds.
And because you're a nerd, you broke it down by the hour, you still have that number?
This is what I do. So what that comes down to is for every hour that the stock market's open, they are buying $291.6 million an hour.
Guys, you gotta listen. You gotta understand this. And this is a side note. As we're preparing for the episode, Scott tells me, wait a minute. I have no idea what he's doing. He's just breaking it down by the hour. Like, come on.
By the way, I had to go to 3 different calculator apps on my phone to be able to type in 70 billion because everything else stopped me at 70 million. But so anyway, so the government has been buying these mortgage-backed security bonds to lower interest rates, but the only way they could combat inflation is to raise the Fed funds rate. And the government's not going to be buying mortgage-backed security bonds, which is lowering interest rates, and raising the Fed funds rates, which could be rising interest rates, because they conflict with each other. So what they have to do is they have to start off by tapering and eventually not buying any more mortgage-backed security bonds. They got to do that first, and then they could talk about raising the Fed funds rate. Now, the Jerome Powell has been very public that their plan...
Who's Jerome Powell?
So he's the Fed chairman.
Okay. He's the boss?
And he's the boss. And he's been very public in saying that we are going to taper our purchasing of mortgage-backed security bonds with the expectation of it ending in March. Now,
I'm sorry to interrupt, but this is something that I think it's important for people to understand. This is a live market we're talking about. Yes. It's a live market like the stock market is a live market, right? So every time that the Fed meets, and they do their minutes, and they do that. You're making fun of me because of my accent.
No, I just... That's so rude. It is funny. Go ahead.
Every time that they meet, and they do a press conference, and they say things like that, those are market movers.
100%.
So, a lot of times, guys, and this is something that's important to understand, the fear of inflation is just as strong as inflation itself.
Absolutely.
Because investors, and these are large, for the most part, the people that buy bonds are large institutional investors like the government.
Yes.
They act on not what is happening, but what they think will happen. So this fear of inflation right now, it's what's driving these rates to continue to go up as of today, the beginning of 2022.
Absolutely. And here's a sentence I don't say very often, but I'm going to say it here.
I'm right.
So before both of our times.
Oh, wow. long time ago.
Okay. If you look at former Fed chairpersons Burns and Volcker, late 70s, early 80s, inflation rose to 14% and mortgage rates rose to 18+%. Whew. And I don't know how many listeners
Double
remember
digits,
that,
baby.
but that's a real deal. So there are plenty of people walking around America that when they hear inflation, their brain goes there, and that's a scary reality.
Okay, so let's bring it down, right? So let's bring it down to, we're geeking out a little bit on the rates.
Spanish.
So let's bring it down a little bit. So when we're talking about all this inflation, when we're talking about how we expect the rates to go up, the expectation really, I mean, obviously we don't have a specific number, but the expectation really is rates are going to be around 3.75, right?
Yeah.
Or like you old people like to say, 3 3/4.
Right. So the government's going to start taking steps to combat inflation, and this will have an increasing pressure on mortgage rates. Now,
Because the government needs people to buy houses.
and the government needs to tame inflation because nothing could crash us worse.
Regardless
right?
of houses, you're right.
So now, I don't. My heart goes out to the members of the Fed that are trying to balance those two things because those are two very difficult things to try to balance right now. And what they're saying right now,
Jay Powell, I just want you to hear that Scott's heart goes out to you.
I'm sure he's concerned. They're currently targeting 3 rate hikes in 2022 and 2 or 3 more in 2023. And we have to understand that until the Fed really starts acting on this, inflation and interest rates can still rise. But once the Fed is successful in taming inflation, mortgage rates should drop. And here's another prediction. They're going to drop to at or maybe below 3%, like you said earlier.
Boom. And that's where, I'm sorry, dude, you got a dramatic pause there.
Dun, dun, dun.
That's where you're not hearing this from many people. Everybody's saying buy now, go crazy, only because the rates are going to be 4 and 5% by the end of the year.
Yes.
Look, I'm going to be completely honest with you. Before I did the research, I was under the same impression, not 5%, but I was under the impression that unequivocally, the rates were going to continue to gradually go up from the beginning of this year all the way to the end of this year. After we did the research, we realized that the expectation is for the rates to go up and then to drop. Not drop more than they are today or that they were yesterday, but drop more than they will be in a couple of months.
Now, another thing to think about, okay, going back to our history lessons, when Burns and Volcker, prior Fed chair people, when they responded to inflation, they were successful in doing that. However, the S&P fell down 30%, led America into a recession. Under Alan Greenspan in the late 90s, early 2000s, he was also able to get inflation tamed. The S&P dropped 50%, recession. Do we have a repeat of this where Jerome Powell is expected to get inflation to decline, which I'm sure he will? Does that mean that the economy will slow down and we will go into some level of recession? Now, before we go any further, I think we got to talk about the wild cards because there's this vid thing going on out there that could take everything we're saying and flush it down the toilet, and it's impossible to predict because we have no historical data.
And look, we're in Florida, so you heard about COVID and you might just brush it off. I know a lot of people do. But again, the point I was trying to make earlier was it's not just a matter of what's happening in reality, but also perception. So the perception of COVID sometimes is even worse than the reality of it.
Similar to inflation.
And obviously that's a market mover. So COVID is a big wild card. What else?
I think that's one. I think the supply chains.
The supply chains is a wild card.
Is a derivative of the COVID thing. But
and another derivative of COVID is what type of reactions are the governments going to have against COVID? Are they going to give away more money, which obviously increase inflation, or are they not?
Right. And are there going to be more shutdowns, which exacerbate the supply chain issues, which exacerbate the inflation, which could cause the Fed to react either faster or more strongly? Right. These are, again, this COVID and all of the derivatives of it are massive wild cards with this. And like I said a second ago, impossible to predict. But here's another prediction I think we can make, that all of this will have a negative impact on the stock markets. And I don't know about you, it would not surprise me if the stock market's down somewhere in the neighborhood of 10%.
I'm going to be honest. I think again, it's crazy when you do the research and when you start looking at the real numbers and when you start listening at the experts, right? Because if you ask me if you tell me, look, the market's going to go down 10% and I just listen to that, that's crazy, right? Because, there's stocks that aren't.
Yep.
But the truth is, it wouldn't surprise me after I look at the numbers. And The reality is that, fortunately, unfortunately, however you want to see it, the combination of the government itself working together to lower inflation and the stock market maybe taking a hit is what makes the rates potentially go down at the end of the year.
Absolutely.
Because, like we always say, money is finite, right? Governments and big institutional investors, they have the money itself is not infinite, so they choose where they're gonna invest that money. And if the market or the expectation is that the market is not gonna continue to rise, they're gonna take money out of that market, which lowers the market, and they're gonna put it into the mortgage-backed security bonds, which lowers inflation. Lowers their mortgage rates.
Mm-hmm.
So that's how we see this beautiful roller coaster that we're expecting
Absolutely.
to happen.
Now, look, let's segue, right? The people listening, if they're still listening and they're not bored to death by the damn interest rate
Only
conversation.
lenders.
Yeah, for the three lenders still listening to us, let's swing this over to the housing market, okay? Because
That's what matters, right? At the
Of
end of
course.
the day, why do we care about the freaking interest rates? The only reason I care about the mortgage interest rates is because I don't even care about mortgages. I care about the house and how much is this house going to cost me.
absolutely.
Period.
So let's talk about that, okay? Through every indication out there, the housing market is going to remain super strong through 2022, but this roller coaster of interest rates, as you mentioned, okay, and keep in mind, even though we talk about rates going up to the high threes and then dipping down to maybe high 2s or 3%, that's still higher than the 2.5% that it was. So this is going to soften demand. Another thing that's going to soften demand is house prices have jumped up a bunch. So demand's still going to be strong, but softer than it was in 2021.
Well, another thing that's going to happen is just this inventory. We still haven't kept up with inventory, and that's not going to happen anytime soon.
No, and again, this is another COVID derivative, okay? How much of the supply chain, I mean, the semiconductors are, like, people aren't even talking about that. The semiconductors are in all of our household appliances and a million other things. You can't finish a house without semiconductors, and semiconductors are a problem. I had a part break on my stove. It took me 9 months to get the part.
Yeah, it's crazy.
It's a real thing. So the supply chain thing is going to continue to be an anchor on the amount of homes being built. And the only way we can get out of this is by lots of homes being built. So the supply is going to increase. The builders will get some additional momentum ahead of them, but it's still going to remain tight. How tight depends a lot on COVID and shutdowns and friggin' cargo ships sitting in the Pacific Ocean for God knows how long, and all of these things is going to keep the supply tight. And I mean, NAR came out with a report, and I don't remember the exact data, but they said something like it's going to take 6 years to get caught up with demand.
Well, think about the demand issue, and I think that's something that a lot of people don't look at. And when you're looking at demand, there's this storm happening right now that we were going to have to face regardless of COVID, but COVID made it 100 times worse, right? When you look at birth rates, and we talk about this all the time, right? The biggest population of Americans right now is 33 years old, right? It's my generation, not your generation, but my generation, right? And the average age per NAR of a first-time home buyer, it's a 33-year-old. Why does this matter in the inventory? Because that 33-year-old, that first-time home buyer, they're gonna move out from the place that they're living in, which might be college or might be their parents or whatever, and they're gonna buy a home and they're gonna take a home from the inventory.
Versus me, where I would sell one and buy one and it's a wash.
So the inventory stays the same. So we were going to have this influx of first-time home buyers coming to the market. And right when this influx of first-time home buyers was going to come to the market, we put a hard stop on every home being built. And on top of that, once we play the play button again, it's not really 100% back because of what you were just talking about. And if you look at specific markets like we're in Florida, it's even worse because we have the COVID that happened. We have the stoppage of homes being built. We have all the first-time home buyers as well. And on top of that, we have everybody that is not a first-time home buyer that's selling a home in the other states and they're taking a home from the inventory here.
Look, this is not a politically correct topic, but it needs to be mentioned. Certain markets like Florida, Texas, the Carolinas, there are people that are fleeing and moving across the country, A, because they can, because of work from home, and B, to run away from the politics and the COVID restriction in various states. I'm speaking to people all the time that, hey, I live in X states. I came down to Florida on vacation. I didn't realize that it could be so quote unquote normal. And I want to buy a house and never leave. I talk to people, I have that conversation with people a dozen times a week.
Normally we talk about, look, Florida is a paradise, it's beautiful, the sun. Now we just have to say, like, the groceries are open.
Yeah. It's a very real thing that people are moving down here based on politics, based on our like them, dislike them, irrelevant. The fact of the matter is people are moving down here for these reasons in a huge, huge way. I read a statistic the other day that the state of New York, New York City, had as the people that moved out of there to either Florida, Texas, 1.1 million people left New York last year.
Wow.
There's 7.8, I think, million people in New York City.
Yeah, percentage-wise, it's huge.
15%.
So, okay, all of this to say, let's move from interest rates and all of that to what happens with the housing market and appreciation, for example.
Yes.
What effect does all this moving into here and the short of inventory has on appreciation? And this is where the inflation, and this is where the struggle that a lot of, let's be honest, a lot of buyers have. It's a struggle for buyers, but it's a wonderful, wonderful thing for homeowners.
Of course it is. And, there's a lot of pressure from an affordability standpoint. And, I'm talking to people all day long. And the truth is this. Yes, a larger percentage of their money has to go towards housing than they did 2 years ago. That's just reality. But the affordability index is still low. It's way lower than it was in 2005 and 6. So because, although houses have gone up in price, interest rates are still very low. Wages have gone up. There's billboards at McDonald's by us, people paying $13 to $15 an hour. Oh, yeah. So, when you look at affordability, you got to balance all that out. The talking heads, they talk about appreciation immediately correlated to affordability without understanding the other components of it. And by the way, there's a whole other component of the housing market that not enough people are talking about, and that is the stupidity of the rental market. People think it's hard to find a house to buy. I can't speak for the rest of the country, but down here in Southwest Florida, good luck finding one to rent. I was just talking to somebody. She had to go up from $300 to $360 to buy a house. It was just the math on it. And her payment was going to like $2,300, $2,400 a month. And she was exacerbated by that. And I said, have you looked at rents? And she said, yeah. I said, what are you looking at? She goes, $2,800. I said, great news, you're up 4.
Yeah.
And you own it, and appreciation and amortization gain.
Well,
and blah,
not
blah,
just
blah.
that, but when you secure a rent, you secure it for a year normally.
Yes.
And the expectation is that rent is going to go up 5% year over year.
Yes, on a national basis.
That's it. So, when you secure a mortgage, sure, insurance and taxes might change a little bit, but you're basically securing that principal and interest, right? I don't know many people that are doing adjustable rate mortgages nowadays.
No, and the ARM rates are almost higher than the fixed in many cases. Hey, pro tip for you guys listening. Either do it yourself or partner with a lender that does it. A buy versus rent analysis, a proper buy versus rent analysis is going to be your best friend in the coming 12, I would argue 24 plus months, because a proper buy versus rent analysis, and that's not, hey, rent is 28, your mortgage is 24, you're saving 400. No, that is one piece. It is over the next 10 years, $2,800 in rent grows to $3,300. How much money are you saving cash flow? How much has your house gone up in value? How much have you paid down on your mortgage? How much did you pay in closing costs on the negative side of thing? How much did you pay in closing costs to go in? How much are you going to pay in real estate commissions to get out? When you factor all that out, people will be up hundreds of thousands of dollars on a 10-year plan in the vast majority of markets throughout the country.
And their break even is immediately. I mean, it's very, very close. They stay in the house for 6 months. I mean, we're seeing 4 months and they're already in the green.
I literally just ran an analysis for somebody yesterday. They were paying $20,000 above asking, and it was a 4-month break even.
Look, I was just talking to a good friend of mine, and I mean, not to wear anybody's dirty laundry, but a good friend of mine, not going to mention any names, but, the one person in the relationship really wants to buy this, what seems to be an overpriced house. The other person in the relationship doesn't. And the truth is, from a financial perspective, let's not talk about livability factor, feeling good, sleeping comfortable at night. From a financial perspective, it just wasn't a bad call, because when you look at appreciation, when you look at amortization, when you look at what they can sell it for, when you look at the difference between buying or renting something similar nowadays, they were ahead, even if a year from now they regret the decision and sell it.
Look, it's like we always say, people see a house visually, fall in love with it emotionally, but the ultimate decision to buy is always a financial decision, unless you're dealing with somebody that just has so much money it doesn't matter. And
send it to us.
Yeah. So that's what's going to go on. The housing market, high single-digit appreciation. The rental market, 5% appreciation is going to go up. Rent's going to go 5%.
I would say that the housing market, we're going to see an appreciation of over 1% month over month.
I think that's a super reasonable number. And by the way, that 5% rental figure is a national number. I damn well assure you that number's higher where we're sitting right now. So interest rates are going to go up, high 3s, end up 3, high 2s. Inflation's going to go up and go down. The stock market's going to drop a little bit. A recession is possible, maybe not like a catastrophic one. When you say recession,
what's a recession? What's a recession?
A recession is
2 quarters of the GDP
of negative GDP. So it's 6 months. So this is not this. This is not 2008. This is not an economic collapse. But a recession is certainly possible. Maybe end of 22, going into 23, and overall things are still going to be crazy. And we still need builders to build as much as possible. And if you could get listings, this is the way to do it.
So, the Real Estate of Tomorrow podcast, right? We just gave you our expectation or prediction, I guess, for tomorrow, right? For this next year. Now, it's up to you to now think of this and think, okay, if this is actually going to happen, how am I going to talk to my clients? And this is where this is powerful, right? Okay, you know what's going to happen with the rates, or at least with research, what is expected to happen with the rates, what's expected to happen with the market. This is where you need to take that knowledge and put up a solid presentation for somebody that's interested in buying a house, to really explain a couple of things, to really explain what the strategy is with buying a house today, and also why you shouldn't wait to buy a house until later. And, I know we're running out of time. We'll do a whole other episode on what we like to call the bulletproof buyer presentation. Yes. But this is the type of knowledge that you need to bring to the table in order to be able to advise people properly on why buying now makes sense.
And look, it's such a valid point, and I agree with you. We have to do a whole other episode of this, because the average real estate agent that I know says, hey, now's a great time to buy. And they expect the people they're talking to have the same level of jubilance. And the truth is this, they're freaking scared. And to get people to actually be successful in their journey, you have to address the fear, discuss the fear, and overcome the fear. Most people I know in both industries, real estate and mortgage, just ignore it. They I don't want to talk about this because I don't want to give it weight. But the truth of the matter is this is a terrifying thing for people. People are scared about 2008 happening again. They are scared that they're making a stupid decision. They're going to end up upside down.
Dude, turn on the news.
Of course.
There's a bunch of reasons to be scared. Everybody, it's a headline reader. Google housing market, and the headlines are insane. But if you actually read the articles, it's like, oh, that has nothing to do with the headline. That's actually really good.
Headlines are just clickbait. Wow, that's odd. That's odd. So look, I guess that's what's going on, right? We're going to do another episode on the type of information you should include in these presentations. But like you said, start thinking about it now, because the question we like to always end up by asking you is this: what are you doing today to be successful in the real estate of tomorrow?
Guys, I'm sorry we geeked out at the beginning of this, but it's important for you to know what's happening with the rates, because the rates drive the market. It's important for you to be able to speak intelligently about this. And like we said, think about these things, think about the prediction, and then in one of the next episodes, we're going to talk about how to turn all this information that we threw at you today into a badass presentation.
And make sure you are partnering with a lender wherever you are in the country. Make sure you are partnering with a lender that has the knowledge, skills, and savviness to partner with you to help get people from point A to point B in this what could be a very scary market.
Scott, let me ask you something. Just for me to know, what was your first interest rate when you bought a house?
I bought a house. I was 23. I built it. And my interest rate
Humble
was
brag.
7.25.
7.25.
And then my second one, I was very excited. It was a duplex, because that's all I could afford at the time. And I was at 6.5% on a 30-year FHA. And I literally remember dancing in my office that I got a sub 7% interest rate.
Wow. That's crazy. My first rate, since you're asking, was 3.75. My first FHA loan.
That is, that was like last week, because you're like 9 years old. All right, guys, listen, thank you so much for listening. Do me a favor, spread the word. This is the best podcast out there. You know it, I know it. Make sure everybody else knows it.
Remember about those 5-star reviews, okay? You can leave a bad comment, but with a 5-star review, and we'll read it.
All right, see you in 2 weeks.
Well, thank you guys for listening. And now it's your turn to implement everything you learned today.
Look, you have a question, you have a topic for a future episode?
Share with us.
Yeah, tell us what you're doing. What are you doing today so you could be successful tomorrow? Send us an email at success@realestateoftomorrow.com.
And don't forget to leave us a review, an honest review.
Screw an honest review. Leave us a 5-star review. And for every 5-star review we get, we're going to send you a badass real estate meme t-shirt.
Those shirts are hilarious.
See ya.